Priya, hello. It's great to be with you here today. For those who know you and for many who are going to come to know you, I'm sure this is going to be an engaging discussion. We're not going to lack for opinions. So I'm looking very much forward to it. For those of you who don't know, this is Priya Parrish. She is a partner and she's the CIO at Impact Engine, which just about everybody I know in the field of impact would consider to be a thought leader, an early mover, and a position taker. So Priya, welcome.
Thank you. Thank you for having me.
You bet. So let's just start, if you could. Just tell us about Impact Engine. What are you guys trying to do? And how do you go about doing that?
Absolutely. So we were started 13 years ago, 2012, really one of the early players, backed by a number of prominent family offices in Chicago, really looking to answer the question of, can you generate really tangible, enduring impact and still get market rate returns? And so our origin story really began when this field was quite nascent. We were one of the first social impact accelerators. So we had companies come to Chicago for a 10-week boot camp, and kind of they were off to the races, pre-seed capital. Over time, as the industry evolved, we were always looking for, what are the gaps, right? Where can we offer products that will fill in gaps to move more capital into the space? Because we are a public benefit corporation, and our public mission is to move more capital aligned with impact. And so we launched a early stage venture fund in 2015. We began that strategy. We launched a private equity strategy and fund beginning in 2019. So we're really early in many of these asset classes. Fast forward to today, the way we're set up, and the way we think we can best serve this ecosystem and fulfill our mission, is that you should think of us as really one of the only independent, completely dedicated to impact asset management firms. So everything we do is to drive impact in one of three areas: environmental sustainability, economic opportunity, and health equity. We think of those as the big three. Allows us to cover a lot of ground. And we do it in private equity markets, ranging from early stage venture through growth equity and controlled private equity buyout strategies. We can invest in a few different transaction types within those stages. One is we are primary fund investors. We invest in funds. We tend to be quite strategic, actively involved, typically a named advisor in almost all of our funds. We can co-invest with them as well. And we also make our own direct independent investments. We have a direct investing team led by my partner, Tasha, that's been around since 2012 as well. So within that window, that's kind of what we do. And we offer our own commingled vehicles for LPs to come in. And we can also partner with larger organizations to create custom separate accounts with very specific mandates that they like. So yeah, I'll pause there.
That's fantastic. And I have to say, in 13 years, that's an enormous amount of work.
We're tired. We still have energy.
Yeah, great. Good for you. And kids.
Yeah.
How do you and the team get it all done? Like, who does what? How do you think about, resources? Give us a little inside baseball.
Yeah, in my experience, I've spent about 20 years in the investment industry, primarily as an allocator. I've done this across asset classes. I spent a number of years in the hedge fund industry, doing, large anchor investments and emerging managers, seed deals, things like that. But I also spent a good part of my career developing products. I developed some of the early ESG ETFs and mutual funds. And with that perspective, one of the kind of principles that we think are really important to execute on this is that everyone on the team has to have some kind of specialization. Now, together with multiple specialists, you can cover a lot of ground. And so we can really conquer these three thematic areas across stages because everyone on the team is a specialist. Now, they have to specialize in something, but it can be thematic. So we have impact leads, for example, who focus entirely on health or entirely on climate, right? But we also have strategy and transaction type leads. So, for example, I lead all of our investments into funds because that is my background and career and what I've been doing. Tasha leads all the investments directly into companies, and she's been doing that for 25 years. And so you kind of, when there's a particular investment to be made, you bring together the multiple specialists to really be the deal team and do the work, but then you benefit from the broader team's I think one of the things we pride ourselves on and that we're quite critical thinkers. We're always very open-minded and revisit things. We forget whose idea it was, but good ideas come from anywhere. And collectively, it gives us, when we talk about diversity, we really think about like really diverse perspectives, like not just by definitely race, gender, but professional upbringing as well to get to that right answer. So that's how we organize ourselves. We're 12 people on the team, based in Chicago, but we have a few people, in other locations as well.
You and I have talked about this, Priya, but I want to revisit it. That theory that you guys put into practice is one that I think a lot of firms would try and emulate. No doubt, the bigger you get, the harder it is. But it's probably fair to say, with no disrespect to anyone, most fail at it.
Yeah.
Right? How do you guys knit that together culturally to make sure that what you're trying to achieve, that differentiated set of opinions, without, call it, overweighting one person's opinion? How do you do that?
Yeah. I think that there are a few key ingredients, but also you have to continually be committed to that and work for it. One is that we do very intentionally, whenever we're hiring, we're looking for an alternative experience and perspective, which allows us to have mutual respect. So, for example, when I'm speaking to my impact lead focused on economic opportunity, I know that's his expertise. So when I ask a question, I really want to know his answer because I
Mm,
don't have it. And when
right.
someone has a question about, fund investing, which is my area of expertise, they really want to hear my answer, because they're learning something. And I think we get really excited when all of a sudden these different perspectives align. And when they don't, we naturally don't want to invest because why would I want to invest in something that this expert here doesn't really believe in? Right. And so that's what we do. But I think a lot of it also does come down to like personality and values of the firm. And humility is one of our core kind of stated values of our firm, a growth mindset.
Mm,
And we really don't keep track and do often forget whose idea it was, but we are continually. I think when you operate that way, it becomes embedded in the culture, but you have to continuously foster that.
yeah. That's a fantastic attribute for a firm. I think it was Golda Meir who said, "Don't be so humble. You're not that great."
That's right. Yeah.
um, um, let's get a little bit into the weeds here, if we can.
Yeah,
Right?
please.
When you're thinking about a specific deal, how do you
Mhm.
think about stacking up impact versus the deal itself? And I want to get to a question that I know is important to a lot of people. What about the trade off between the two?
Great. Okay. I'm going to separate this into two different answers because there are deals that are companies and there are deals that are funds.
Great.
And
Yeah.
there are similarities, but there are clear differences.
Hmm.
Let's start with the company. So there are a few important aspects that allow the integration of the financial and the impact. And that's ultimately what we're looking for. We're looking for business models, teams, and markets where what it means to be successful impact wise lends itself or can drive what it means to be successful competitively, from a margins perspective and financially. And for us, one of the first kind of key principles is that we're typically looking for product or service based impact, meaning the product or service has been intentionally designed, by an entrepreneur who really, really understood why that market failure exists, why people or businesses are not getting what they need at the right price point in the right place, whatever, and have designed it to solve for that. They bring some insight, and the more of those things they sell, the more impact they create. But obviously, thinking through cost structures, thinking through scale, and everything in between in the team, the devil is really in the details in that diligence. But it's not a separate track, right? We're really diligencing. So when we're thinking about the team, we're thinking about impact as well as do they have the skills, the go-to-market experience, the financial experience, etc. When we're diligencing the market, we're diligent in the competitive environment, we're diligencing impact within that, like who else is doing this, where could impact actually be a disadvantage, etc. So it's embedded. um and you know and so let me pause there and let me go to the fun side. So on the fun side, in many ways, I'm going to say two contradictory statements. on one hand, we're looking for funds who do what I just said, who are like us, right? Um, and because we have, over a decade of experience doing this, whereas a lot of impact fund managers are much newer to this than us. So we have that pattern that, like, hey, if you're not embedding it, if you're not thinking about those trade-offs from the first deck you see or the first call and you're doing it at the end, you're going to miss it. And you're going to get emotionally biased in one way or another, or anchored. And so we're looking for that trait. And on the other hand, we're also, I guess, going back to our firm value, try to be as open-minded as possible that there are multiple ways to do this. That is the beauty of this industry. And not just the impact industry, the investment industry. There are a million ways to skin a cat, right? And two very smart people can come to very different opinions about what's a good investment and a bad investment. And so we try to be really open-minded and really listen. But the thing that connects those two disparate arguments is the thing we don't let go of, which is that you have to have a team, you have to have the fund manager really, really understand their market. If they are not an expert and they don't understand why that market failure exists, and they have not built a strategy that really addresses and cuts to the core of what kinds of companies could succeed, impact, and financially, then we're not really interested in hearing their novel idea of how to do this. And so across companies and funds, it's very much integrated. Now, the trade-off question, do you want me to go there next?
Yeah, please.
So, I come from, I started out in the impact space the first couple years of my career as a product developer, as I mentioned, but I very quickly left because I became quite jaded. And this was ESG 1.0 at that point. But I found that a lot of people around me didn't have any financial training or grounding in fundamental, like what makes for a great investment. So I went to business school, I went to Chicago Booth, and built a career in the hedge fund industry as a fairly mainstream investor, and always was trying to connect the dots back to impact. And that was like my personal guiding question of, like, what does it look like? Where can these two things be reinforcing? And have a lot of, theories and beliefs about that. But ultimately, I think if you look at the fundamentals, any reasonable investor can see the arguments and counter arguments both ways. So, for example, the one a lot of people point to, which is, if impact can lead to better talent attraction and retention, whether it's a startup or a fund, that's a positive. On the other hand, if trying to be impactful makes it so you have to lower your price in order to make it more accessible, it can lead to lower margins, and it can lead to non-competitive financial returns. So, and I can go through, there's many, many, many examples that you could say this is why it would, and this is why it wouldn't. And so it is always about, not just the intentionality and the objective, but the how. How are you investing, or how are you building your business, and going into those details. And so I think the whole range is possible. However, one of the kind of more existential or theoretical questions that our firm spends more and more time wrestling with these days is, when we say market rate, what do we even mean, right? Should market rate only be financial, for example? So if you take two healthcare funds, and everyone thinks healthcare is for the better of people, they're not all. You can have one healthcare private equity fund that got to its target return and a top quartile return, and it did so while creating more access and great outcomes for patients in XYZ way. And you can have another private equity healthcare fund, buyout fund, get to the same return, but it did it by investing in, hospices by lowering quality of care, right? Or name your healthcare segment. And so we kind of think market rate should include financial and impact, but there's going to be a lot of infrastructure having to be built before that, in addition to risk, right? Like a market rate risk adjusted return is really, really important. So I believe it's all possible. I believe you have to have a really strong objective strategy and then execution to achieve whatever you are trying to do financially.
Yeah, obviously, I agree with that, and I think that's why the structure that you guys have built, where impact and financial performance are just integrated as part of the entire investment process, is so powerful, because it allows you to make those decisions real time within the portfolio, not ex ante or ex post, which is the way a lot of people approach the problem, unfortunately.
That's right. And there's
You
going to
know,
be winners and losers. That's what I always try to
sure.
tell people. Just like in normal investing, not everything works, but kind of going in from the beginning. And then also knowing, we always talk about optimizing returns too, Rob, because for
Yeah,
us, we're not willing to we're not willing to push the return for any cost. We have to have impact there, but we're
sure,
not also willing to invest for the max impact with disregard for the return.
sure.
So there's somewhere in the middle, the center of the Venn diagram, which does limit your investment universe,
Yeah.
that we're really striving for.
But then when you limit your investment universe with that logic, you're just being authentic to your LPs, right? You're giving them what you said you would give them.
Yeah,
And to me, one of the words that I wish we could banish from the world of impact is concessionary.
that's right.
Because there's really, if I as a fund manager have said to you as an LP, this is what we're going to do and this is the return you will get, there's no concession.
That's
I
right.
may fail at that, I may exceed it,
Yeah,
but it's not a concessionary promise, right? If
right.
I say to you, you'll get your capital back and that's it, because it's PRI,
Yeah,
that's not a concession. And similarly, if I say we're going to be really aggressive here and we're going to get market rate plus, that's not extra. That's what I expected. And so many people, I think, want to go to that sort of what is market rate and is it above and is it below? And it's just it's a false comment, I think, on performance that we just don't need. It's just not helpful.
exactly right. And again, if you put impact aside and you just look at whatever asset class, private credit, there is a range of returns that
That's right.
managers target, and for good reason.
Yeah.
It's not always this exact same, return outcome, nor the
Yeah.
same way to get there. They get
Yeah.
there in different ways.
Yeah. So true. Um, so I mean, you guys subjectively, observationally have a process that works, right? On the other hand, a lot of fund managers would say, yeah, we do that, and can't really prove it.
Mhm.
So there is this discussion about measurement and metrics and how you manage, your performance and how you display it. How do you guys think about that?
Yeah. So starting with, I would say, the impact reports and financial reports are after the fact. But when you're doing diligence, you really want to look at way before then, because especially
Yeah,
in private markets, it's a long time before you really see the result.
that's right.
So if you actually look at our diligence and our memos, which we share with all of our investors, you see both the business and impact diligence, as well as the impact side culminates in a theory of change and a thesis and proposed metrics. So you see that from the beginning. You see a side letter or impact commitment agreement that commits the company or fund to managing their business to strive for these outcomes and measure it. Um, and then you see us collecting metrics and commenting on the impact um, on well, we collect it roughly twice a year, but we do quarterly reports. So an investor gets a letter from us, financials, investment schedule, as well as impact at the company level, every single company, every quarter. So it's embedded. It's one package, and you get it. Um, and after there is an exit, whether it's a positive or negative exit, whatever it is, we also try to go back and analyze and be like, did what happened? What impact was created? Um, and so we think about both measuring as well as managing impact throughout the life cycle, before we invest, during the time we invest, and after we invest. And that's how investors can know and hold us accountable, but that's also how we know and we hold ourselves accountable and try to improve.
Yeah.
um, and that's just kind of, again, it's um, part of just the way we do things.
So it is, and it always has been.
Yeah,
But let's wind the clock back a little bit,
yeah,
right? To maybe earlier days.
yeah,
Um, at the Impact Evaluation Lab, we've tried very carefully and very studiously to develop a methodology that does not punish or let's say does not critique early stage managers just because they happen to be early stage. There are things that you can do because A, you're well endowed, but B, you've also been learning for
Yeah.
over a decade, right? So how do you think about that in the context of an earlier stage manager? How do you think about on the fund of fund side,
Yeah.
evaluating a fund manager who hasn't even placed capital yet, for example?
Yeah, it absolutely can and should evolve. We have a very similar belief system. Uh and so for a new manager who's just getting going, what needs to be clear is that they understand their market and what the problems are they're trying to solve, that there's real deep insight there, and that their strategy, including criteria, like what they need, what they're looking for to invest, reflects their theory of change as to what will create those outcomes. If they don't have that and they have empty words, mission driven,
Right,
purpose driven,
right.
honestly, quite frankly, even climate, focused on climate, that means nothing to me. What do you mean? What is your criteria? If they don't have that, they
Yeah,
should not get started.
yeah,
Over time, they will learn from making the investments and realizing that's we're collecting it the wrong way or asking the wrong information or the
yeah.
frequency and we're reporting it wrong. Yes, but we can. By the way, if you've been around 30 years and you're not still growing, you don't deserve anyone's money.
Mm.
You got to keep, evolving
Yeah,
and
that's
growing.
right. Yeah,
But certainly, you have to start with what is your objective and criteria. That gives you conviction that that objective could be met.
right. That's right. I mean, we're on the same page there. I get so frustrated that I've started to use the phrase the McDonald's of impact.
Yeah.
30 billion people served. It's like that's not impact. That's
No,
just the number of people that you happen to serve.
you can serve them very poorly.
That's right. We were
That's
once evaluating. This is at a fund I used to run. We were evaluating a healthcare company. It was a healthcare services company,
Mhm.
and they claimed to be servicing lots of people who were incapable of getting healthcare services because they were distanced from it, right? Rural communities, that kind of thing. And immediately when you pulled back their map of who they served, their geographic map, 90% of the people they served were in the suburbs of Boston, Massachusetts. I mean, there's no healthcare services geography in the United States that's better endowed than that.
Yeah.
And they had like a few places in, rural New Hampshire and a couple in Vermont and you just thought, oh, all you're really doing is competing on price versus the incumbents and driving people towards your business. It's total nonsense.
Yeah. That's
But
right.
they were insistent that they were impact.
Yeah, well, I will
So
say, the diligence principle I kind of grew up with, was trained with is, first tell me, then show me.
yeah, sure,
People can say whatever they want, but show me actually in the portfolio.
yeah,
Show me.
yeah,
Without that, the words mean very little.
very little. That's right. So how rigorous are you in your metrics? I mean, let's get to the punchline here, right? Like, do you insist on it from a company?
Yeah, yeah,
Yeah,
yeah.
you do.
That's a core requirement
Yeah,
in
yeah.
writing. Absolutely.
And do you think about metrics sort of relative to an existing situation?
So the way we think about it, and this also depends on stage. So like a pre-seed company, their metrics are going to be very different than a $50
Sure.
million EBITDA
Hmm.
company, right?
Hmm.
Um, and it also depends whether we're coming into a situation where they already are measuring it and we're kind of weighing in to say, yes, this kind of meets it, keep doing it, or they've never done it before, let's
Hmm.
co-develop it. Or you're investing into like an M&A situation or a new business line situation where the metrics are going to relate to something coming forward, right? I think it very much depends, and we try to be partners with companies and funds
Hmm.
to say we know that metrics can evolve and should evolve often. The commitment is that you're going to do it, and you're going to do it with a certain, frequency and fidelity to best practice. But the metrics do often change.
Yeah, which is fair.
Yeah,
It's fair because information changes
that's right. And businesses change.
and businesses change. Let's pivot a little bit. I know your career started, you just said it, but started sort of in what we would loosely call the ESG space,
Hmm.
right? How do you think about the the challenges that ESG as a concept are facing right now,
Mm-hmm.
and the impact community, and are there warning signs for us?
Well, it's interesting. When I got started, I worked at the first ESG ratings provider called KLD. It wasn't
Sure.
called ESG then, but they ended
Right.
up being sold to MSCI.
That's right.
And back then, the way we got our information, we had like a bullpen of analysts, and I was on the product side. We had a bullpen of analysts, and they would spend their time, Googling, and it was actually earlier days of Google, trying to and try to locate 10Ks and annual reports, and literally doing control find on like whether companies had a recycling policy.
Yeah. Yeah.
And then you would call or try to get a hold of an investor relations department and get them to answer your question. There was no glass door, there was no right,
No.
and it was all primary in many ways, and so the quality was very, very low. Um, and we had to go through this whole evolution of that space to really prove that this is not just an externality, but there's financial materiality here, right? And that's what led to ESG getting to the point where it is now, where it's so ubiquitous, because people have understood that. And not all ESG data, but for every company there's some amount of ESG data that's financially material, that it's actually imprudent to not do it. So it's the label is no longer wrong. Is now wrong. I kind of think of it as context data. It's risk management data. That's it. And that's also the shortcoming, or why I believed that the ESG trajectory of that strategy was losing its ability to create impact. It was doing a great job capturing these externalities as internalities, but it was no longer going to be impactful. And so I think the risks facing that space have to do with terminology and an objective, and people being clear with that. On the impact side, and for me, that is actually that cuts into the exact difference between ESG and impact, versus when you're an impact investor, it's not just considering these things and the financial materiality of it. It's actually saying, I'm trying to create this outcome. So the objective is different. And you could say, well, that exposes itself to maybe greater political scrutiny. And yet, I try to remind people that actually the very heart of why impact investing exists actually is, I say it's an investor's right. Just like if an investor, says, I don't care, and this could be an institutional investor or it could be an individual investor who says, I understand that stocks generate higher returns over time, but I'm risk averse and I only want to invest in muni bonds and I hate paying taxes and that's all I want to do.
Sure.
Go ahead. You can do that.
That's right.
People make all sorts of illogical decisions all day long. I've seen it. I've seen it in family offices, just people's personal opinions. They don't like this country. They're not investing. They like, right? Makes no sense. And so as long as impact funds and impact investors, I believe, focus on that this is their objective, right? And that's why impact has to be part of the investment objective. It has to be part of the investment policy statement. It has to be part of the LPA. It has to be part of it. It's simply fulfilling that. And back to our earlier conversation, whatever your return objective is your return objective. Funds have all sorts of different ones, and this is what it is. And then the question is, are you fulfilling that or not? And so there's obviously policy headwinds and tailwinds always. Again, I think that impact funds or impact investors are generally, if you look at the thematic areas that people focus on, they're generally long-term secular trends.
Yeah.
And I think you get investors who, in some ways, take that for granted, saying, well, we know, demographics are changing, preferences are changing, business needs are, so it doesn't matter, we're policy immune. And it's not true. Long-term secular trends have a lot of volatility in the middle. On the way. Even if you're right, you can be really wrong and go out of business. And so impact investors right now need to be quite attuned. I mean, they've all had to be, but now, it's being shown how attuned you were, to be policy resilient, to invest
That's right.
across multiple changes, are there fundamental economic drivers that, regardless of regulation or taxes or incentives or tariffs, um, the business can reasonably get through. And again, you're always going to have losers, but um, you kind of have to do that.
But
And
by the
one
way,
of
that's what a good investor does.
that's what a good investor does. Period.
Yeah. I mean, you look at your market,
Yeah,
you look at whether or not you've got something to contribute to the market, answer a question, answer an unfulfilled need, and then can I create margin by doing that?
that's right.
Right.
And an impact investor who really understands their market should. And that's if we don't want to fall prey to what happened with ESG,
Yeah.
you better be damn good at that. And
That's
if
right.
you're not, we're gonna have a big problem.
That's right.
We're gonna say, what's the point?
That's exactly right.
You know?
Yeah. I've always thought of ESG as conceptually as the end market for impact. You think about a solar panel, right, or a wind farm, right? If if you're creating that, that's impact. If you're a company that leverages that technology, that makes you a quote better ESG company, but it also just means you're implementing what that product or service
That's
does,
exactly right.
right? Yeah, and if we want to have a more sustainable world, you need all of it.
That's exactly right.
Most of the noise around ESG these days has to do with execution. It's not really about the concept.
No, no.
So pivoting again uh, into some more maybe personal issues. So you've made a lot of decisions. You've worked with a lot of people. You've done a lot of deals. Is there one or two that you think, "Ooh, I wish I had that one back"?
Oh, I mean, who couldn't?
Right.
Um, I always try to do pre-mortems. So, like, before I invest, think about,
Yeah.
if this doesn't work out, why would it not work out? And then when it doesn't work out, go back and say, were we right? Because,
Yeah.
right, as an investor, as you know, like, if you're not taking risk, then you're not an investor.
Right.
The question is, are you good at identifying the bets you're taking?
That's right.
Right. Um, and so I would say there's categories of this, but the vast majority of the things that fall into the category of our execution risk, and things that we did identify as, we knew that, like, hey, if this doesn't work
Hmm.
out, it's because it's going to need a lot more capital because it's not
Yeah.
capital efficient. If this doesn't work out, it's going to be because we are going into a pretty competitive dynamic. If this doesn't work, right?
Yeah.
And so I feel pretty good overall. And I think any decisions and investments that kind of have a pattern to them that don't fall into that execution, we've evolved, right? That's kind of
Mhm.
what leads to your evolution.
Yeah.
So for example, I'll give you one, and kind of speaks to how our firm is, or our product offerings are organized today. You know, when we started out, we've always been focused on these three areas: economic opportunity, health equity, environmental sustainability. We didn't have specialists though. So we added the impact leads and the specialists, because that was like a learning. You actually need specialists. So now I can say it
Hmm.
confidently, but we didn't always have it.
Yeah.
And then when we started investing in funds, because we were direct investors beginning in 2012, added fund investing in 2019 when I joined, um, we started to realize that the level of specialization a firm can have when they're fully dedicated to it is like, it's like next level. Not just like a
Hmm.
specialist, but like an entire organization of former CEOs, policymakers, and whatever sector. Like, whoa. And we realized that that's the kind of specialization that certainly gives one an advantage. And over time, we developed like a view around asset owners as well as impact investors, where they kind of tend to pick their one or two impact areas that they want to focus on. So XYZ Foundation's focused on climate, or XYZ is focused on education, or whatever. And it leads to like fairly mismanaged, lopsided portfolios. These are not
Hmm.
institutional portfolios. And so what we believed our contribution, and what I talked about, when we launch products, we think about gaps in the market. So we realized the gap in the market is actually well constructed portfolios. So now we offer funds that are hybrid
Hmm.
vehicles. They're each a little different, but typically 60% of the capital goes into a small handful of funds, maybe 5 to 7 funds, that are very specialized. They bring that full stack of specialization, but in 6 different markets. So there's no overlap. And you get a portfolio of specialists. So you get the diversification. And then maybe 40% of the company goes into 10 to 15 companies that we're selecting that we believe are, the best of, and not just these funds, but our broader network. And so you get a little bit of the oomph and the touch and the feel and the upside and downside of direct investing. And you get a really, really well risk managed portfolio that is actually difficult for most asset owners with an impact lens to do it themselves.
Sure.
If impact is only 10% of your portfolio or 30%, you don't have the bandwidth, you don't have the dollars, unless it's 100%, you got a hard time doing that. And so we say someone needs to do this, and we're doing it. And so that is an evolution of seeing, wait a minute, specialization does matter. Wait a minute, portfolio construction matters a lot.
Yeah.
And in private markets, a lot of people don't think about portfolio construction. In public markets, as you know, that's half the battle. So we said we need to bring this to this world. And that's I think a key thread in some of the lessons learned and how it's evolved.
That's a great way to articulate one of the challenges that I think a lot of people face, that balance between specialization and generalization, right? It's, a lot of consultants will talk about a core and satellite approach or whatever, but you must have an enormous amount of learning about fund managers because you're also looking at the same companies some of them are looking at.
That's the synergy there.
Yeah.
And I will say, I've been an allocator for a number of years, but right now, this is the most fun ever because I show up to a fund manager meeting and, I know how to invest in funds and I can grill them and whatever, but I get a colleague of mine who all they do is direct investing and they're asking them questions and they know these companies they're talking about.
Right.
And it's a level of diligence that is better than I've ever had. And I've worked at a $14 billion, hedge fund funds. This is a real strategic advantage to have the true direct investor sitting right next to you.
Yeah, no doubt about it. In fact, I'm a little jealous. Let's pivot into personal if we can.
Yeah.
So this is what I call our speed round.
Okay.
Nothing's going to take you by surprise, I don't think, but a few quick questions. So one, food that you would eat out because you don't make it at home.
Sushi.
Ding, ding, ding. Number one answer, by the way.
It must be, yeah.
Yeah. Food that you do cook at home that you would never eat out.
I'll put a caveat, but I'll say Indian food, but my mom's, not mine.
Okay.
My mom's Indian food. There's no restaurant like it.
Right. Fair enough. When can I come over for dinner?
That's right.
So favorite musician?
Oh gosh, that's hard to narrow down. As also probably a lot of obscure musicians. So I'll give you one that probably most people know is Brandy Carlisle.
Oh yeah. Yeah. I'll be right with you there. If you were home on a Friday night, what would you be doing?
Oh, movie night with my kids on Friday nights. Movie night and pizza every Friday night.
Well, that begs the question: what kind of crust?
I'm from Chicago, but I now I lived in Michigan. I'll say I'm all about the diversification. I can appreciate them all, but I like a pan pizza. That's probably like my go-to, which I guess I've become kind of like someone from Detroit now.
Yeah. Oh, I'm sorry to hear you say that, but I get it. If you had in your life one thing you could only do forevermore, what would it be?
Yeah. Okay. I'd probably be a park ranger.
Nice. Nice. Little lonely, but I get it.
I'm with the animals and trees.
Yeah, I get it. Well, Priya, this has been a real treat talking to you today. I mean, it always is, but being able to do it a little more formally is always fun.
Yeah. Thank you.
Thank you.
Yeah.